This week, price is the question, in the absence of value. More after this short message.
Building relationships is the way Mutual of Omaha has grown into one of the leading financial services companies in the world. Our reverse mortgage wholesale division is proud to carry on this 100-plus year tradition. To your borrowers, a reverse mortgage is more than a transaction. It's a promise of a better, more stress-free life. Our goal is to provide you, our valued client, with the best service and support possible so you can focus on helping your borrowers achieve the retirement of their dreams.
Welcome back to the Industry Leader Update. Reverse mortgage professionals watching right now, you often encounter the objection that a reverse mortgage, especially the home equity conversion mortgage or HECM, is just too expensive. And certainly from a dollar and cents point, one could argue that. But after all, what other loan does have an upfront FHA mortgage insurance premium equal to 2% of the home's appraised value up to the HECM limit? The answer is no. So how does one overcome pricing objections in the first place? Well, first, pricing objections often have nothing to do with the loan's cost. Frequently, it's because the homeowner either doesn't understand what has been presented to them, or they don't feel that the potential benefit of getting the reverse mortgage justifies the upfront costs. However, pricing objections lose their power when the value of a reverse mortgage is properly understood. As a previous guest on this show, wealth advisor Ryan Ponsford said, "Price is a question in the absence of value." So how do you build value in the mind of a potential borrower? The first way is to build value by focusing on the potential real-life uses of a reverse mortgage. Give them an example of retirement with and without a reverse and make them feel it. Let that sink in for them. And to do so, you must not only know their outstanding mortgage balance, but their monthly payment. In fact, if you're only fact-finding to see if they can qualify for a reverse, then you're ignoring the other remarkable benefits of a reverse mortgage that could be tied together with fact-finding. For example, if their monthly mortgage payment is $1,750 a month, you could say, in the first year of getting a reverse mortgage, you will have increased your cash flow by $21,000. What could you do with that? The second way to build value is to address long-term care, the proverbial elephant in the room. No one likes to think about it, but 4 out of 5 people 65 or older will require some sort of long-term care in their remaining years. Even more sobering, only 1 in 10 or 11% of Americans over 65 have a long-term care policy. Now, those with few assets, such as those who are house rich and cash poor, can't afford long-term care insurance premiums in the first place, and they'll likely depend on Medicaid. But those who do have significant assets may have foregone a long-term care insurance policy. Lawforseniors.org notes that premiums for LTCI are relatively high. The average premium is $3,000 to $6,000 per year, depending on age, sex, health, and the maximum daily benefit, the length of the benefit period, and the length of the elimination period, or just how long the policyholder must wait before benefits are paid. Furthermore, premiums are not fixed and can increase over time. Many have found that after 10 years of paying premiums, that they're unable to pay the premiums that have now surged by 30% or more. Without long-term care insurance, retirees will have to tap into either their savings, retirement accounts, or other assets for care. In such a circumstance, what would the impacts be on their monthly income or the lifespan of their retirement or investment portfolio? Now, homeowners that have significant mortgage balances could leverage their extra cash flow by eliminating the required monthly mortgage payment they once had and instead contribute it to an account to be used for any potential long-term care expenses. Now, reverse mortgage borrowers that may have a small mortgage balance or none at all could greatly benefit from the growth of a home equity conversion mortgage's increasing principal limit, or what we like to call a line of credit. And that could be another source of funds for care. The third way to build value of a reverse mortgage is to illustrate the power of the HECM line of credit growth. For example, when hedging against long-term care costs, a HECM line of credit of $200,000 with an assumed effective growth rate of 6% would increase to $212,000 by the end of the first year, $225,000 by the end of year 2, and an astounding $358,000 by the end of year 10. Even better, if you account for the $210,000 of cash flow retained by not paying 10 years of their mortgage payment, and you combine that then with the available credit line at the end of 10 years, the homeowners could have up to an additional $440,000 available for long-term care expenses when they're likely needed. In conclusion, to build value, you must have a basic understanding of the homeowner's present financial situation, their concerns, long-term goals, and risks. If you connect each of these to a reverse mortgage, then you've built value that eclipses most pricing concerns. If you take anything away from today's episode, remember this: the value you must deliver has to exceed the cost of the reverse mortgage. Now, what are your thoughts? Leave your comments in the comment section below, and please share this video on LinkedIn with other professionals who can benefit. We have a YouTube channel. Be sure to subscribe and hit the notification bell. And if you're looking for the most recent reverse mortgage news and developments, you'll want to listen to our weekly podcast, HECM World Weekly. We also do have a video companion to that podcast as well, which you can find here at HECM World. Have a great week, and be sure to return next Monday for more reverse mortgage news, commentary, and analysis you'll only find here at HECM World. Have a great week.